On Friday, June 5th, 2026, Bitcoin broke below $60,000 for the first time since 2024. It touched just under 59,100 at the low, down about 16% on the week, its worst week since the FTX collapse in 2022. Ether hit a 14-month low. $1.5 billion in leveraged bets got forced sold in a day. The Fear and Greed Index read 16, deep in extreme fear. So the headline wrote itself. Crypto is crashing, maybe dying. It's the wrong read. This wasn't a Bitcoin problem, it was a liquidity problem. The money didn't get destroyed, it walked out the door. And the interesting part is, who carried it? So where did the money go? Two parts to the answer. We can show you exactly who sold, and it wasn't who you'd think. We can show you who was buying right through it. Where every dollar actually landed is the harder part, and we'll separate what the data proves from what it only suggests. Here's what really happened. Start with the levels. Bitcoin had peaked above $126,000 back in October, and by Friday it was worth less than it was the day a crypto-friendly president retook the White House. The alts went down with it. Ether slid as much as 13% to around $1,550, its lowest since April of 2025. And then there was the spark everyone seized on. Strategy. Michael Saylor's company, the firm welded to the words "never sell," had sold Bitcoin. 32 coins, out of more than 843,000 it holds, sold for about $2.5 million to cover a dividend payment. Its first sale since 2022, and a tiny one. But it broke the meme. As Delphi Digital put it, the old "never sell" line is now broken in practice, not just on conference calls. Jim Cramer wrote that Saylor murdered Bitcoin. The doom around all this is loud and worth a second. About $2 trillion of crypto value has evaporated since the October peak. Crypto is dying is the headline, and it's the same headline that ran in 2022, right before the market came roaring back. Even believers are walking. Mark Cuban said last month he'd sold most of his Bitcoin after deciding it failed as a hedge. But a 32-coin sale can't move a market this size, and the 2 trillion number isn't the story either. The real weight was somewhere else. The cleanest statement of what was happening came from Saylor himself the day before the break. He wrote that capital markets are funding the AI build-out at historic scale, roughly $400 billion over 6 months, while Bitcoin ETFs had seen about $4 billion in outflows since mid-May. Those are spot Bitcoin ETFs, the funds anyone can buy that hold the Bitcoin for you. This is a capital rotation, he said, not a Bitcoin impairment. Capital rotation just means money moving from one trade to another, not money getting destroyed. The destination he's pointing at is the AI build-out, and that leads to the thing hanging over the whole market, the IPO wall. That's a cluster of huge companies all going public around the same time, each one a giant vacuum for cash. 3 of the biggest names alive are in line. SpaceX is expected to list around June 12th at $135 a share. OpenAI is targeting September, and Anthropic is aiming for this fall. CoinDesk notes those 3 together could raise more than $200 billion, though that's a forward estimate, not money raised yet. He's not alone in the read. Baird's Michael Antonelli put it flatly. For the longest time, crypto was the hot investment Silicon Valley obsessed over, and AI displaced it. Whether the dollars literally walked from one to the other is the part we'll test later. The rotation story needs one qualifier, though. June 5th itself wasn't really an AI rotation day, it was a rates day. That morning, the US jobs report came in hot. The economy added 172,000 jobs in May, against expectations closer to 85,000, roughly double what Wall Street penciled in. A strong labour market sounds like good news, but for anyone hoping the Federal Reserve would cut interest rates, it's the opposite. Because cheaper money lifts risky assets, and a hot jobs print kills the case for cheaper money. By Friday, the CME FedWatch tool showed the odds of a rate hike by year-end jumping to about 73%, up from 51 the day before. The 10-year Treasury yield pushed above 4.5%, and the dollar hit an 8-week high. So everything risky got hit, not just crypto. The Nasdaq fell more than 4%. Semiconductors, the heart of the AI trade, were the worst of it. The main chip ETF dropped 10%, its ugliest day since March of 2020. Even gold and silver fell, which tells you this was broad de-risking, not a safe haven move. Bitcoin somehow missed. So the rotation is the multi-week undertow, while June 5th itself was a rates-driven risk-off day where even the AI trade got sold. Both are true at once, and that's the gap between the slow story and the fast one. Now to the part the data actually proves. Here's the part worth slowing down for, because it's the one place we move from story to evidence. CoinShares ran the numbers on professional investors using their regulatory filings, the 13 F reports big money managers have to file. Read this carefully, because the timing matters. This is first quarter data, the 3 months ending in March, not the June week. Over that quarter, professional holdings inside the Bitcoin funds fell from about 313,000 coins to 261,000. And the breakdown is the whole story. Hedge funds and brokers did about 95% of the selling. These are the fast money desks running short-term arbitrage trades, not long-term believers. Then look at who didn't sell. Financial advisors, the people managing money for ordinary clients, held the largest share and trimmed it barely, under 6%. Banks actually added, JP Morgan, Wells Fargo and Citigroup for the first time, lifting bank holdings to 15,200 coins, and Abu Dhabi's sovereign fund added too. So this was concentrated professional de-risking. It was not retail or long-term holders capitulating. That's the signal. Now where the money actually went. This splits into what's measured and what's inferred. What's measured. While crypto bled, money market funds, basically cash, hit a record above $8 trillion, paying a risk-free yield around 3.3% in late May. Yield is just the interest cash pays you for sitting still, and when cash pays you that for doing nothing, the bar for owning Bitcoin goes up. Also measured, the main chip ETF was up roughly 80% on the year, while Bitcoin was down about 32%. What is not measured, and this matters, is dollars literally leaving a Bitcoin wallet and landing in SpaceX. Those companies are still private. You can't trace that flow, and CoinDesk's own line uses the word may for a reason. So here's where it nets out. Crypto outflows, an AI fundraising boom, and AI outperformance are all happening at once. The rotation is the best supported explanation for the gravity, but the exact destination is inferred, not measured. Matti Greenspan of Quantum Economics said it best. Bitcoin isn't facing a Bitcoin problem, he said. It's facing a liquidity problem. That leaves a real case on each side. The bear case lives in the treasury companies, the firms that exist mainly to hold crypto on a balance sheet. Strategy is the giant, and its strain is real. It owes well over $1 billion a year in dividends on the preferred stock it sold to raise cash, with a software business too small to cover it and a Bitcoin pile that pays no income, while its running paper loss on the stack sits around $12.8 billion. A forced seller with bills to pay is the fragile spot. The bull case is that the buyers with conviction are stepping in. Strive bought $185 million of Bitcoin during the slide. Standard Chartered's Jeff Kendrick said the bottom is almost in, pointing to ETF holdings that stayed structurally intact through the whole drop. And CoinShares framed the month as a sentiment shock, not a structural break, with the asset class close to flat for the year. Two real cases, both sourced, pointing opposite ways. That's a market, not a verdict. So watch the dials, don't predict them. These are the live dials as of June 5th. First, the ETF door. A 13-day outflow streak, the longest on record, drained about $4.37 billion from US spot Bitcoin funds before a tiny inflow broke it on Thursday. If the outflows resume, the rotation is still running. If real inflows return, the biggest buyer is back at the table. That's the cleanest tell there is. Second, Monday, June 8th, when the market learns whether strategy bought back, sold more, or did nothing this week. Kendrick said a buyback would be a tentative sign the low has printed. Third, the holders. The provable read was that long-term holders weren't the ones selling. Watch whether that holds, or whether the underwater long-term supply finally cracks. Fourth, the SpaceX listing, expected around June 12th. Watch whether selling builds into it or eases once the positioning is done. A clean launch could actually release the valve. And behind all of it, the Fed meets June 17th, the first under new chair Kevin Warsh, and we find out whether that rate hike repricing sticks. That's the loop. Crypto didn't crash on its own. The buyers had walked out the ETF door, and then a hot jobs report shoved an already fragile market, while the gravity pulling capital away had AI written all over it. So back to the question, where did the money go? The desks doing the selling were the fast money crowd, hedge funds and brokers, about 95% of it, while the banks were quietly buying. Who sold, we know. Where every dollar went, we don't, and anyone who says they can trace it is selling you something.